Yo, peace, family. It's your boy Tez, a local financial ninja providing everyday knowledge on personal finance and money matters. Today's just gonna be a quick, short video. A lot of people been asking me to just do a video on financial loans. I mean, not financial loans, but student loans and financial aid and things like that. So I just wanted to touch on that and just kind of give you my perspective and my hints and tips on how to stay in the loop and how to take control of your student loan situation, man. I know when you come out of school, do 4 years, you come out 60 to 150K in debt, man, and it can be very intimidating, to have that much debt and to have somebody sending you a bill and calling your phone every other month about $60,000 to $150,000. So yeah, just wanted to do this quick video just to provide a little bit more information on that. Let some knowledge be born on that subject matter. So when it comes to funding your education and getting student loans, so there's two different options. So basically, you have private student loans and then you have federal. So private student loans is basically you're going to a private lender, taking out a loan for 60 or 150K, whatever. Or if you're doing it by year, whatever your yearly costs or semester costs, you're just taking out loans for each of those terms from a private lender such as a bank, credit union, or a family member or something like that. That's never too bad. Then you have the federal loans, which is the most popular, most used loans to fund education in our country. So the two biggest difference between a federal loan and a private loan is that federal loans, since they're backed by the government and insured by government funds and funded through like public funds and tax dollars and things like that, they have lower rates. There's always flexible payment options for those, and there's always different plans and different options as far as like deferment, forbearance, and loan forgiveness. So there's actually a way to get your loans forgiven if you're working for like a state job coming out of college, but we'll get more into that. So as far as the federal loans, there's basically three types of federal loans. You have subsidized, unsubsidized, and you have the plus loans. So most of us know about the subsidized, unsubsidized, and the plus loan as far as terminology, but I don't think it's really ever broken down to people, so basically the difference is a subsidized loan, it's subsidized. So there's no interest while you're in school, at least half time, and there's no interest accruing during the grace period or deferment. So if you're to take out a loan and then you'll go to school with that during your whole course of school over half time. So if you're enrolled in school over half of the time, as far as when we're talking about being a full-time and a part-time student, no interest is accruing on your debt. During your grace period was like 6 months after school, there's no interest. Or during a deferment period, if you actually put your loans into deferment, there's no interest being accrued. So unsubsidized loan is basically the complete opposite of that. Interest is charged during all periods. So as soon as you take this loan out, interest begins to accrue. As soon as you go to school, whether or not you're in school or not, half time, no time, full time, whatever, your interest is accruing on that. And then the plus loans is basically a way of lending through your parents or using your parents' credit score, social security number, whatnot, tax identification number to get more funding to go to school. Because a lot of times, often, you're not granted as much funds as you need through yourself. So what I had to do actually my first year of school is I had to get like partially a parent plus loan. So that's basically another way of lending through your parents. And so whenever you do get out of school and you're going into the repayment phase of everything, the post college phase, some of the tips for your student loans, man, is to just stay in the loop, man. Stay in contact with your loan service provider, maybe Nelnet or one of the any of the various different providers. But yeah, just stay in the loop, stay in contact, stay emailing, stay calling them. Hit them up before they hit you up, man, because that's basically, hey, it'll make you feel better and more confident about the situation, even if you do owe $100 and something thousand. And it'll give them more confidence in you if you're dodging them. Like, yeah, my daddy ain't home right now. You can't be dodging the bill collectors, you know what I'm saying? Especially when you owe them that much money, because they can start coming for your wages and all different kind of situations and things like that. And you don't ever want any bad credit reporting. So it takes 3 months for them to report any negative activity to the credit reporter. So just make sure you stay on top, pay on time. And also what you want to look into doing is doing the consolidation. So through Obamacare, they have this new option to where you can do you can consolidate all of your federal student loans. So instead of having 4 loans for each year, well, 1 loan for each year, which would be a total of 4 loans. On average, once you get out of school, you can consolidate those, and instead of paying 4 different interest rates, um, you basically pay one interest rate and have 1 loan on your credit history. So, I mean, 1 loan is better than 4 different ones. And if you have 2 unsubsidized ones, I mean, it might be better to do the consolidation, because the consolidation, is basically subsidized, and you can put those in deferment, and it won't no interest be accrued if you put those in deferment after you consolidate. So, that's another big option, big tip that you can do. So some alternatives to paying for your college education, if you don't necessarily want to go and do a federal loan. I mean, if you're a non-traditional student, you're already established, and you have work history, you have like a house and a mortgage that you're paying to. Depending on how much equity you have in your house, you could do a home equity line of credit. So that's basically a collateral back loan, or you could do a HE loan, which basically is a collateral back loan using your house as the capital. So whatever property that you own, whether that be a house, commercial real estate, or anything, land, you could always do, a real estate backed loan. So you could put that up. If you're looking towards like saving for your kids, college savings accounts like the 529 plan is very popular. If you don't want your kids to be in the same situation that you were in after school, get started on that early. 529 plan, put $100 away a month, towards, junior, or your little daughter. We don't want to be sexist, but yeah, junior or your daughter's college. Start saving earlier, and that plan is basically like it'll go into a managed portfolio. So you'll put all that money up, turn it over to an investor, and he'll like be aggregating a bunch of you guys' plans and investing that money and flipping it together so he can fulfill the fiduciary responsibility at the end of the day, which is to have enough money for your kids to go to college. So yeah, check that out. 529 plan is really good. I really like the home equity line of credit, especially for the non-traditional students, because it's like, man, if you're already established and you can get a lower rate on a home equity line of 3% versus a federal rate that may be 5%, why not? Hey, go ahead and do it, man. Go for the gusto, dog. But yeah. So in order to get the federal loans or whatnot, you gotta complete your mastery promissory note, which is basically like filling out the contract for borrowing the funds, man. You promising. Your master promissory note is basically the ins and outs and all the fine print of the contract as far as borrowing the funds. You have to go through that, and you have to initial a bunch of spots just to make sure that you acknowledge that you have at least looked at the documents. I'm pretty sure that everybody doesn't read through it, but yeah, you gotta complete your master promissory note and your online counseling. So during the online counseling, it'll just basically go over overview of loans, federal loans, subsidized, unsubsidized, parent plus loans, what's going to happen, deferment, forbearance, forgiveness, what's going to happen once you get out of school, and all of those good things. So, yeah, so your grace period once you get out of school is 6 months after you drop below halftime. So if you ever get out of school full time, but you have more than halftime, you're still basically not paying any interest on your subsidized loan, so they won't be coming at you or reaching out to you wanting to pay. You got 6 months once you drop below halftime, and then you'll have to start paying those loans back. It usually takes about 10 to 25 years to repay in full. I'm gonna give you a little bit extra tip. They kind of recommend this for mortgages, so they say if you pay an extra mortgage payment a year, it takes off like 7 or 14 years, like 7 years off of your mortgage. So we're gonna go ahead and recommend that to the family. Go pay one extra payment a year, and that could possibly drop off 2 to 3, maybe 5 years off of your payment. So yeah, just pay one extra payment a year, and that will significantly drop the number of years it'll take for you to repay your loans in full. So last 3 options I'm just going to talk about before we close out, family, is deferment, forbearance, and forgiveness. So Basically, deferment and forbearance are basically the same thing. You're basically telling your creditor, your lender, you're basically telling your lender that, you're gonna take some time. You want to take some time and, put your loans into a certain status to where you don't necessarily have to pay back. Deferment and forbearance. You can look those up and just search those terms so you can understand the big differences between those. Sorry, I should have read up a little bit more up on that so I could break it down, family. I like to have a better understanding on everything. When I'm breaking stuff down. But basically, a forbearance and deferment is you're telling your lender like, hey, I'm gonna chill out for this year, take some time, get my financial situation together, then I'll start paying back the loan at this time. And so the forgiveness option is basically like, yeah, if you get a job with the state, you can always put your you do all sorry about that. If you get a job with the state, you have the option of getting your loans forgive. So if you go to college, take out federal loans, come out $160,000 in debt, you can always go to the government and work for them, work for the state and get forgive, or like the Peace Corps, different options like that. So once again, family, it's your boy Tez, local financial ninja. We're signing out. Peace.